I went through a very old school kind of apprenticeship sort of process where over the last 15 years, I was working 100 hours a week, did over 50,000 tax returns and, billions of dollars worth of client earnings. And my tribe is the independent contractors, the small business owners, the solopreneurs. Because what happens in the tax world, in the tax professional world, is that there's kind of two different levels. The planning is absolutely critical. And it's not just about the end result. It's about going through the process of making sure everything's set up in the right way.
Just know there's nothing more patriotic, there's nothing more American than doing everything you possibly can to minimize your tax liability.
Us at Remnant Finance, we're big fans of investing in your own business and investing in yourself. We think that it should be a massive portion of the money that comes in.
On the face of it, unconstitutional. They're already trying to get around that by talking about it as it's a prepayment. So it's not actually a tax, it's a prepayment on the tax that you're eventually going to have when you do so.
It's like a Scooby-Doo episode where we've caught this grocer gouging and then they pull off the hood and it's Congress spending.
Capital gains is the only place in the tax world where we pay current dollars in tax on old money that is not inflation adjusted until there is the political will to cut spending, which is really, really hard because now you're cutting off somebody's gravy train. Then, we're just going to get deeper and deeper into an inflationary scenario.
Hey, welcome back for another episode of Remnant Finance. We're excited. We have a special guest today. This is Neal McSpadden. He is with Tax Sherpa. He's the Tax Sherpa. He is our accountant, both Hans and I. And so we do a lot of discussions with him and a lot of strategy. And he's really changed the way we think about taxes, the way we think about our money flows, and has improved our lives from the tax sense and intangible ways. So Neal,
hopefully tangible too.
Oh, intangible, yeah. But the way we think is what I was thinking about. There is like there were even things that I didn't even know existed, but obviously tangible in the dollar sense.
Yeah.
Why don't you just tell us a little bit about yourself, how you became the Tax Sherpa, what your background is, et cetera, et cetera.
Yeah, I came to the whole tax world in a very unusual kind of fashion. Back in, I was just before we turned on the recording, Hans and I were talking, we both went to the same school. We went to Georgia Tech. And I majored in engineering. And it was interning and working in industry, in engineering, that really turned me off to the whole corporate world. And I can pinpoint the moment. So I was working at AMD out in Austin, Texas. And, they make computer chips. They're competitors with Intel. I happened to be there during the time that the first 1 gigahertz processor was produced and released to the market. And AMD beat Intel to the punch. It was a huge deal. The stock tripled and everybody was super excited. And after everything died down, there was an award ceremony that was held on the corporate campus. And so we all got together in this amphitheater, and vice president of whatever it was talking about how, Joe, he got 3 patents this year. Let's give him a hand. Obviously the patents belong to the company, but here's a plaque. Everybody gives them a round of applause, and it was a whole morning of this stuff. And the last guy is the one I remember. I don't remember his name, but I always call him Bob. So Bob, when crunch time came and we had to ship product, he had a vacation to Europe planned with his family. It was booked, it was paid for, it was approved, his time off and everything. And he canceled that vacation and decided to come into work and be a real company man. Let's give him a hand. And it was at that moment that I realized this is not for me. So that's not the work-life balance that I wanted. And so that's when I started searching for other things. And I spent basically the entire 2000s, trying this, trying that, and doing different entrepreneurial journeys. Some worked, some didn't. And then in 2007, I started getting letters from the IRS saying I owed them $1.3 million. So that was kind of a problem. But like most people, I stuck my head in the sand and I just ignored them. And because I knew, there's no way this could be right. I didn't make that kind of money. I don't have that kind of money. It's just beyond the remote possibility. So I went through the whole process that a lot of people have gone through, where if you ignore those letters and the number's big enough, you'll get a letter every month or so. And then if you ignore all those, you'll start getting certified mail. And then if you ignore all those, you'll start getting phone calls. And if you ignore those, then they'll start going after whatever they can find. In my case, they were garnishing my paycheck. And at that point, I couldn't afford to pay rent. So I let it get to that stage. And then I started realizing, okay, I actually have to fix this. And in searching around, trying to find somebody who could help me, I ended up hooking up with this former Wall Street tax attorney. And he helped me fix my problem. And in doing so, His business was starting to grow, and so I came in with all the entrepreneurial learnings that I had over the last 10 years, and helped him triple his business over the next few years. And he showed me this whole world of tax advisory that I didn't know existed, and most people don't know exists. So, and so I went through a very old school kind of apprenticeship sort of process where over the last 15 years, I was working 100 hours a week, which I don't recommend. But, over that time did over 50,000 tax returns and, billions of dollars worth of client earnings and, saving clients millions of dollars every year. So, that's where I got my start in the tax world. And then in 2020, really, I mean, it's 2019 technically, but 2020 is when I really got started with Tax Sherpa, where I decided to go off on my own and focus on what I call my tribe. And my tribe is the independent contractors, the small business owners, the solopreneurs, because what happens in the tax world, in the tax professional world, is that there's kind of two different levels. So at one level, you have, the strip mall places that have the national chains, or maybe somebody's a solo practitioner, has a small office. And basically, the advantage of those places is that they're relatively inexpensive and they're available. So if you just have a day job and that's all you have going on, then okay, you can go to those places. On the other end of the spectrum, you have tax advisory people that are working with high net worth individuals or big companies, and they'll charge, 100,000, 150,000 for a tax return, not even including all the other stuff, just filing the tax return. And so what happens is the people in my tribe, the solopreneurs and the independent contractors and the small business guys, is that by default they end up going with what's available because they can't pay $100,000 for taxes. That doesn't make any sense. So they end up going to these places that are very churn and burn. They're how do I want to say this charitably? They focus on lowest common denominator kind of stuff. And so if you're a small business person, who's maybe bringing in a couple $100,000 a year, maybe that's not profit, but maybe that's what's coming in the front door. You're just getting slaughtered by taxes. And, by doing the planning steps that you take from that big business world and applying it to the small business person, then we're able to achieve huge savings for people and turn their situations around. So that's how Tax Sherpa came to be, and that's who we aim to serve.
Yeah, that's incredible. And I'd say even from my end, I think that you've downplayed a little bit of a lot of what you do through the year, because most of us who went to that little planning office and just got our taxes done, we handed them a little folder with all the documents that came in the mail. Maybe our really poor bookkeeping will went along with it, and most of them don't take the time to fix that poor bookkeeping, but they just take it and run with it. And then they spit out the return. I've met with you guys so far this year, probably at least, because this is year one. So we're getting a lot of things in process. So we've probably met at least 5 times. Here it is August, maybe 6 times already. You've helped us build out, change the infrastructure of our businesses. You've helped us rework the way the money flows through the LLCs, how we're going to actually do our taxes. So it's a lot of planning on top of that tax preparation. And I don't want to downplay that, because it's tens of thousands of dollars potentially. And if you're making, 7 figures in your business, it could be hundreds of thousands of dollars difference between having a real plan that somebody, an expert is helping you walk through, versus just going to, blank in our block and having some guy plug your numbers, which, I feel like you said, for some people, that works, but not for business owners.
Not for business owners. Yeah. It's all about the planning, actually. And that's a great point that, when you file the return, that's the last thing that happens. Right. And then maybe you kind of check the IRS, maybe they cut you a check, whatever it is. But the goal is during the year. So we're here at the beginning of September, 2024, Q4.
I don't even know what month it is.
Yeah.
I said August.
Well, August just finished, but yeah. So, we're starting the end of year sprint where we want to make sure that everything is caught up. All the plans we want to be in place are in place, and that we can know on December 31st, we can know, like, okay, what are we expecting? And then when we actually file the return in the spring, usually of 2025, that everything matches up with our expectations. So the planning is absolutely critical. And, I imagine it's very similar in your business where, it's not just about the end result. It's about going through the process of making sure everything's set up in the right way.
That's right. That's right. And the final thing for our listeners that I want to, before we move on and talk about some things happening in the world here, is that I want to point out that that Tax Sherpa understands, actually implements and supports what we do as far as with whole life insurance and the infinite banking concept. So that's a really common question we get is like, I would love to find an accountant who gets this.
Yep.
Well, I want to just tell you that if you're listening to this right now, here's one, and here's a really good one who we utilize. So he's not going to tell you that this is a terrible place to store money. You can get a tax deferral if you put it in your 401k. Like, you're going to get a much bigger picture advice. So keep that in mind for our listeners.
Absolutely. So yeah, I'm an IBC. I'm not a practitioner. I don't sell insurance, but I am a user of IBC. So
yeah, little P practitioner, we'll call that.
Little P, yeah. So yeah, I've read Nelson Dash's book. I've read Bob Murphy's book, and yeah, I'm a practitioner with a small P.
And I want to throw in my exposure to you through this business and maybe perspective that people that are listening, many of our clients being military, specifically military pilots, how Brian and I met. You know, we go along our whole career in the worst tax structure, which is your W-2, because you don't even see it coming out the door. Yep. Brian and I say pretty regularly that everyone should be required to write their quarterly tax check, even if you're a W-2 employee, if the system were honest, because when you feel that pain, you would revolt. But for 12, 13 years of my career, I never even thought about it. I was happy for a couple $1,000s return at the end of the year. I could log in and see the taxes each month if I wanted to, but I never really focused on it. And all of a sudden in 2022, I made a little bit of money in this business. And all of a sudden I have a bill of $10,000 to the IRS, and I had to write that check. And I just wasn't expecting it. I mean, I should have known, but like, there's so much out there that we don't even think about. And when we talk about, people always compare this to investments, rate of return, 12%, 10% of the market, whatever. Well, if you're paying a quarter of all of those gains to the government at a minimum, a quarter of that, and we're saying like, what if you could save 25% of what's going out the door? We're comparing it to a 6%, like saving losses is just as powerful when we talk about long-term compounding as earning gains. But there's for our listeners, just know there's nothing more patriotic. There's nothing more American than doing everything you possibly can to minimize your tax liability. That's what our country was founded on. And any hint of the idea that it's patriotic to pay taxes and support this government is absolutely that's communism. It's the worst. It's the worst way of thinking. Yeah, and that's why we are in the situation we're in, is because I'd say a large part of it is that people don't see the taxes going out the door because of automatic withholding. And I would love if you talk any of your thoughts on the automatic withholding, et cetera. Just because I think that for a lot of our listeners, maybe this is the first time they've really thought deeply about taxes, other than just I file it every year on TurboTax, hope to get a little bit of return.
Yep. So what you are saying is exactly right, and was originally a problem for the government. So what happened was in 1913, the 16th Amendment was passed, which created the income tax. There was an income tax during the Civil War, but that was struck down as unconstitutional. So they passed a constitutional amendment. And then for the first 30 years, that's how it was done, where people would file once a year and then they would pay at that point. And the government found out compliance is pretty low. So in 1943, they passed, I always get the name wrong. I keep calling it the Current Withholding Act, but whatever, the Withholding Act, which created the payroll withholding structure that we now are dealing with, because it was World War II. They wanted to raise revenue for the government, and they figured out, and this was actually an innovation by Milton Friedman, Mr. Free Market, figured out that if we get them up front before they see the money, compliance is way higher, and that's absolutely true. So people, like every springtime when tax time rolls around, you'll see all these advertisements. You might see like road signs of like get $5,000 per kid or whatever, and they're talking about the refund. They're not talking about the actual tax itself, because there's a tax liability, and then there's however much you paid in and whatever credits you might get, and then the difference between those two creates a refund or creates an amount owed. very, very few people actually focus on the tax liability itself, because that's, if for most people, if you have a W-2, then that money has already left your paycheck. You never saw it in the first place, so people are just focused on that take-home pay, and then they feel like that refund that they get at the end of the year is an extra bonus, and that's not actually what happened. You just gave an interest-free loan to the government for that money. And then if you actually wait a couple of years, they will pay you interest on it. So they can't wait too long or else they won't pay you. So.
Unbelievable. Yeah, well, and you could have been earning that interest the entire time if you kept that money in your own ecosystem. So the opportunity cost there can be huge. And that's another thing that I also think that you've probably seen. And then let's speak to this real quick, if you will, and then we'll talk about some things going on in the current political world real quick and that are cautionary and frightening, to be honest. But once you get involved with somebody and that person is able to mitigate their taxes to potentially tens of thousands for that small business owner, do you see that oftentimes they feel like they've just got a flush of money that they want to spend? Because my belief is like, this was money you used to be just, handing to the government for their waste and their inefficiency. Why not keep it and put it in a place that creates more efficiency in your own life? And I believe that that's where like what you do ties into what I do and what Hans does. Is we can utilize that cash because you're already used to not living on it and boost everything else you do with a more efficient environment.
That is true. So, we deal with a lot of entrepreneurs, and part of the entrepreneurial curse is that you are very optimistic. So if you have your own small business, you're out there, you're doing your thing, and you're like, if I had an extra $20,000 in my pocket, I could go do this, that, and the other. And that's usually what happens. They will reinvest it into their business in some form or fashion. So there's definitely an argument to be made where it would be better to kind of set this money aside for long-term wealth building rather than, operational spend in your business. But percentage-wise, I couldn't tell you off the top of my head. But I know most people will use that money for, more business. And if it works out, it's great. If it doesn't work out, then that money's gone.
Yeah. And us at Remnant Finance, we're big fans of investing in your own business and investing in yourself. We think that it should be a massive portion of the money that comes in. But the cool thing is utilizing the whole life insurances we do, we can do both.
Yes.
And that's where, people could really optimize those dollars if they learn that.
Yeah. I don't know how much you guys focus on it, but once you hit that tipping point where your premium payments, actually grow, what like 3 or 30 days after you deposit it, you have more cash value available than you put in, and I know the where that happens in the timeline is going to differ for every policy, but I've got some policies that are 8-9 years old now, and so I put money in and I had more money to use, and then I can then take a loan against that and then go spend it on whatever. So I just got my roof done, which wasn't a business expense but needed to be done, and that was $20,000 that I tapped from from an insurance policy. So it definitely works once you lay that foundation.
Yeah, I love it. So Hans, let's kick us off on what's going on in the world, man, and let's see what Neal has to think about some of it.
Yeah, well, the big news bite right now, as far as economics go, would be Kamala Harris's quote economic plan, which is less of a plan and more of a few sound bites, stitched together.
Yep.
Kamala's economic, thesis is about the weight of an 8th grader giving a speech in U.S. government, but with less clarity. Like there's really no thought to it. It's full retard. But and typically we don't really give too much credence to what politicians say, because if you do that, it's just chasing a vapor trail. But it's not even worth considering almost, except it seems to be part of the tactic, that AOC almost perfected, where it's like you say the most outlandish thing, and Democrats are surgical at this. You say the most outlandish thing that's so beyond the pale that people just kind of roll their eyes and like, oh, that's crazy. This Green New Deal is insane. And now 5 years later, that's the norm. And then you have these idiot Republicans that are like, oh, ours is the better New Deal. Ours is the real New Deal. And they're spinning off of this terrible idea. But the whole thing is that it impermeates into the culture. So it's like, it's not far off in the future that this is going to be seriously debated. So even if it's just a joke right now, it's in the national psyche, and everyone who doesn't understand capital gains, let alone unrealized, this whole thing, people are at least starting to look into it. And then if you hear this retarded puppet Kamala Harris just saying it over and over, then you might start to internalize the idea. And that seems to be kind of the strategy. Like, I don't think there's any chance that in the next year they start taxing unrealized capital gains, but we should talk through it and try to be a kind of a wall to hold back this terrible idea. At least our a couple hundred listeners can understand what's happening. So what is unrealized capital gains, and why is it obviously one of the worst economic decisions ever?
This will take 5 seconds. If you'll give me a second, Hans, I want to actually point out that what you're saying isn't just true. It's you're actually living the back end of that, because Janet Yellen first started talking about this in 2021, and Nancy Pelosi jumped on it. And I don't think Biden and Kamala really touched it then, but I'm not 100% sure. But this train started in 2021 on unrealized capital.
I don't think they're sure either.
So what's that?
Oh,
I said I don't think they're sure either. One,
yeah, they're not. But I mean,
just...
we're now at year 3 of this verbiage starting to enter the lexicon of like what politicians promote to the unassuming masses. So what you're saying is actually in process. This isn't day one. It's wild.
Yeah, absolutely. So before we talk about unrealized capital gains, we should probably define what realized capital gains are. So in the tax code, the way it's written, if you hold a non-inventory asset, so like the classic example is you hold a stock, right? So you buy Apple computer or whatever, and you hold it for more than a year, then it gets classified as what's called long-term capital gains once you sell it. So if I bought $100 worth, it rises in value over the however long I hold it, and then it's worth $200. Now from there, I have a $100 gain. So from 100 to 200, it's $100. And then I pay a special rate tax on that capital gain, which is called long-term capital gains. And the rate it depends on how much total income you have for the year, because there's 3 brackets for long-term capital gains. And that's either 0%, 15%, or 20%. And basically the way the math works out is that it's always going to be around half of whatever your rates are for your regular income. That's going to be your capital gain rate. And that's the way it's been for effectively forever. If you hold something less than a year and you sell it, then it's short-term capital gains, and it counts the same as any other kind of income. There's no special preference. But for holding more than a year, you get that discounted rate. So, what has happened historically, especially with people who are founders and owners of successful, like mega successful businesses, think Elon Musk owning Tesla and Starlink and all these other things, is that they follow a strategy called buy, borrow, die, where you buy an asset or you start an asset if you're founding a new company. That asset grows in value, and instead of selling it and triggering a capital gains event and paying taxes on it, you borrow against the value of it. So similar to how IBC works, you can borrow against stock. If you have a large enough portfolio, you can open a pledged asset line with your broker, and you can borrow against the value of that stock. If you have real estate, you can borrow against the value of that real estate. You're never going to get the whole amount, but you're going to get a significant fraction of the value. And because it's a loan, that's not income. So, if you have a successful business that goes public, you can borrow against those shares, not pay any income tax, spend the money on whatever it is you want to spend it on, and then theoretically, you can keep doing this forever until you pass away, and then it all settles out in your estate. So that's the buy, borrow, die model. And over the last, 10, 15 years, the politics of wealth envy have been ratcheted up, as we've all seen. And so this proposal that they're talking about here is really targeted against that. And so what they're talking about now is that, so back in March of 2024, the Biden administration released this whole budget proposal for 2025, along with a whole bunch of tax changes in order to support the budget of 2025. And this was one of them. And so when Biden got thrown out and Kamala got put in, nobody was exactly sure. It's like, how much of this are you standing by, and how much of this are you going to just ditch and come up with your own policies? And we still don't know exactly, but the implication that has been made through various media outlets is that, they've talked to insiders, and, Harris is standing by this proposal from March. And part of that is this unrealized capital gain. So the way the plan is supposed to work is that instead of waiting for somebody to sell their their shares of Tesla or whatever, they are going to be assessed a 25% tax each year on the unrealized gain. So unrealized means you haven't sold it. You still own the thing, and then you are paying a 25% tax on that increase that year. And so that's the basic plan. There's a bunch of caveats to go along with that. So the proposal as it currently stands, as far as we know, is that they're only going to apply this to people who are worth 100 billion or more. So there's two things that come to mind immediately. So one is that when the income tax was passed 110, 111 years ago, that was sold as only the 1% are going to be paying this. And now here we are 100 years later, and everybody's dealing with the income tax. So you can't rely on that at all. Already, Elizabeth Warren's talking about lowering it from 100 million to 50 million. Second thing that comes up is like, well, how do you know if somebody's worth 100 million that they should owe this tax? And, basically in effect, people would have to be reporting their net worth to the government, which is not what happens currently. So that's the second thing. And then more things start to just cascade immediately. So under the 16th Amendment, there is a tax on income. So if you didn't sell anything, you don't have any income. So on the face of it, this is an unconstitutional proposal. But that does not necessarily mean that it will, happen, right? Because like Brian, like you were saying, they've been talking about this publicly for a couple of years already. So they're moving the framing of the conversation along to get this done. So on the face of it, unconstitutional. They're already trying to get around that by talking about it as it's a prepayment. So it's not actually a tax; it's a prepayment on the tax that you're eventually going to have when you do sell. And it's an interesting tactic. I don't know if it'll work or not, but it is. They're at least cognizant of the issue, I guess.
I mean, if I just think about homes, because so many people can actually relate to that outside of the 100 million. But if you had bought a home in 2004, it probably appreciated at quite a degree between then and 2008. So 05, 06, 07, by end of year, you would have seen some great appreciation. And should this tax have then moved into the common man's world and any assets they own, they might have asked you for 25% of that. So let's say that house you bought it for 100,000 and 3 years later it was worth 150. Well, you would have gotten assessed a tax of 25% each year of whatever that gain was. But then in 2008, your house was worth, 110 instead of that 150 that you just were assessed a tax on. You lost your job and you want to sell your house. Then it's not, you weren't taxed at the future gain. You were taxed at something that didn't exist. That money that didn't even exist, which is kind of it's the exact type of money our government loves, money that doesn't exist. But man, that's frightening because like you said, going back to 1913, like the top 1% were going to be taxed, or the lowest bracket was 1% there in the early years. I don't know the whole timetable. And it's like, 1%, it's not, you don't feel terrible about it, but that can have a massive impact on wealth. And now it's well above that.
Yep. Yeah. So, on the 1913 thing. So originally it was only on incomes above $3,000 a year. And you have to, adjust your inflation expectations. So I actually went through this with ChatGPT the other day. It says, okay, in 1913, gold was $20 an ounce. And, that equated to whatever that 150 ounces of gold a year of income. And now that gold's $2,500 an ounce, what's the equivalent income that you would need now? And the answer is $375,000. So if we had kept that same kind of inflation adjusted tax basis, you would only be paying taxes above $375,000. And so that would exempt the vast majority of Americans, like 95% of Americans, from paying tax. But, because the needs for government funding have grown and grown and grown, they just ratcheted down on more and more of the population. But yeah, so, in this proposal with the unrealized capital gains, so what happens if the value of the asset falls? Do you get a refund? Nobody knows. What happens if you don't have the money? So, and there's been a couple suggestions of how they would handle the liquidity issues, especially with closely held stock, because they're really targeting the tech entrepreneurs with this. So the Elon Musks and the Mark Zuckerbergs and all that kind of stuff. But that's just the starter group, like we've seen. That's always going to creep. There's always going to be scope creep as time goes on. A recent example of this is actually the alternative minimum tax. So the alternative minimum tax is AMT, which is where if your income is high enough, depending on your filing status, no matter how many deductions you have on your mortgage interest, your charity, and all this kind of stuff, they're still going to tax you a minimum tax. And so when that was originally passed, it only affected whatever the top 10%. But then as inflation eroded the values, then it just started affecting more and more of the population. So this is we've seen this in recent history where this exact dynamic plays out. But yeah, so if prices come down on your asset, do you get a refund? We don't know. The big problem though is the liquidity issue. So there, back in the I guess 50s or 40s, there was all these movies about people losing the family farm, and it's because of the taxes. So well, mortgage and taxes, but if you're assessed a tax on a thing you haven't sold, and that the value of that thing is a large percentage of your net worth, then by definition you don't have the money to pay for it. So then it's going to create forced sales, and in order to raise the funds in order to then pay the tax. Either that, or you borrow against the thing and you're financing the tax on the thing that you're still holding, which could then go down in value, and you have all these risk factors. So it's a terrible situation to be in, for sure, for anybody caught there.
The idea of that forced sale, you have this tax bill, but you don't have the income. A decent proportion of people that have this bill due now for gains they have not yet realized are going to sell the asset that generated the gains, driving down the price. And so this whole idea of we're helping people, it's like, well, the people you're trying to help are the ones who you've convinced a 401k is their future saving grace. And so if the rich, quote, are forced selling these assets, because why would you keep holding these, and the stock market plummets, and we're talking about tech specifically, and we know the S&P 500 is 7 stocks that are doing well and 493 stocks that are faltering or stagnant. If you eliminate the gains by forcing sale from these tech entrepreneurs of their own stock, you're going to drive the only 7 performers in the S&P 500 off a cliff and bring down the only thing that you convinced most, quote, average Americans to put their money in. And so it's so stupid. It's so self-defeating that you have to think. I mean, these aren't stupid people. The current administration, like brain dead and just a total vapid mouthpiece with no synapses to rub together, is the current administration. But apart from those two, like Janet Yellen, I had her as a professor or a visiting professor in grad school, and I don't agree with their economic mindset, but they're not idiots, of course. They know this is a terrible, terrible thing, obviously. And if a smooth brain pilot like me can think through a few evolutions of how this would play out, of course they're doing it. So you have to think the intention is destruction, right? They're trying to rebuild, take down the American identity through this, and this is just one of the many avenues that they're using, right? There's no way that they're this incompetent, even though we joke about how incompetent government is, and of course they kind of by the nature of the system, they are incompetent, and that's a good thing. But this is intentional destruction, right? How else can you view it?
Yeah, pure malevolence. There's no other way to describe it.
Yeah, I've been convinced in the recent years that the purpose of an organization is the thing that it does. So people talk about government incompetence. I think you're just picking the wrong goals that you think they're aiming towards. So I think they're very competent at the things they're trying to do, because those are the things that they do. So it's only if you buy the PR that you think they're incompetent.
Right. It's like safe and effective. It's like, well, when we hear that, we think safe and effective means safe for the person taking it and effective at what we think it's supposed to do. But in reality, it is safe and effective. It's safe for the manufacturer from liability, and it's effective at depopulation. It's just
it's effective at making money.
Yeah, it is safe and effective, but
that's for sure.
who?
Yeah. So yeah, I mean, obviously they have their own think tank people. They have modeled these things out. Now, their models are probably wrong. I mean, the models are always wrong, but some are useful. Um, but yeah, I mean, there are other countries that have a wealth tax, which is effectively what this is. So I have a friend in Switzerland, and he has to report every year the value of his net worth, and then he pays a tax based on the change. And it's, incredibly onerous, and it stifles capital formation. So, if you part of the problem with an unrealized tax, aside from the unconstitutionality of it, is that it just creates additional drag on the creation of value. So, uh, it's similar to how in IBC, you're always gaining on like the whole timeline rather than interrupting it by taking withdrawals out. So it's the same math as in any other value creation timeline. If you have to, if you're going along building an asset, a new company, a piece of real estate, whatever it is, and then you have to sell down throughout its lifetime in order to pay this tax, and the tax would be every year, then you are going to, reduce the base at which you're compounding. So that the long-term growth is, by the time you get out, 10, 20, 30 years, whatever it is, then the ending point is going to be orders of magnitude less than it would have been otherwise. And, so you got to figure that's actually the point here, is that, they don't want people to have this dramatic outside success because, it's all coming from envy, essentially.
So it's just a reversion to the mean. Let's bring everyone to a lower common denominator, which is that I guess if they do this, then check, they're gonna achieve that. But I don't think it's gonna happen. But let's talk about another one. If nobody else has any more on the unrealized capital gains disaster.
I do want to point out that this would require an act of Congress. So it's not like the president can just sign a thing. So the chances of that getting through Congress are low, but not zero. So it's definitely something to be aware of.
Well, let's talk about price controls, the price gouging ban, which again is like an eighth grader's essay. It's so economically illiterate to look at, say, the profit margins of a grocery store and think that they're gouging when it's like a Scooby-Doo episode where they're, we've caught this grocer gouging, and then they pull off the hood and it's Congress spending. It's like you are the ones doing this. Like if you want to control the prices in the grocery store, you need to look down the road to the Congress and just eviscerate them. But this idea, but like you said, it's targeting that sentiment of wealth is bad, and because these people own grocery stores, and because the person who is in charge of this grocery store is some greedy corporate fat cat, that's who we're gonna. It's an emotional appeal without any economic merit. And I you got to think, even like the most hardcore, even Janet Yellen has to be like, come on, are we really going with this? We know grocery stores profit margins are razor thin. Like this can't be the example we go with, right? Yeah. But they are.
Yeah, it's absolutely true. So even the talking heads on TV are talking about how this is a bad idea. And so you have to figure that if they're not on board, then it's terrible. But yeah, price controls have been tried throughout history in multiple different ways, and there's not one single example where things came out better. And so the current price control that some people are familiar with is in New York City and other major cities, there's rent control. And the net result is you have less supply and lower quality. So the same thing happens with any kind of price controls that will be imposed. And there have been people that have done graphs showing that the price of goods that go into a grocery store, it's like their wholesale costs, and the prices at grocery stores, they're just tracked in line, because the groceries specifically, that industry it's very fragmented. There's no so-called monopolistic pricing power, and there's lots of vendors to it. So there's not just one chicken company that is supplying all the chicken, although there are large ones. But there's competition at all levels of everything in the supply chain, coming from a farm to a packaged piece of beef in the grocery store, or whatever else you buy in a grocery store. So there's competition all along the way. Nobody's able to take any pricing advantage over anybody else. And when we look at the public companies that are, the Krogers and whoever, we can see how much money they're making because they report it to the government, and it's not a lot. I mean, in absolute value, they're huge companies. So yes, there's a big number, but in percentage wise, compared to their costs, it's really, really small. So like historically, Walmart, one of the largest, possibly the largest company in the world, has operated on 3% profit margins. And, they built this whole thing that's, in every country or a lot of countries and throughout our country is so pervasive that everybody knows Walmart. Most people have shopped at a Walmart. A lot of people shop exclusively at Walmart. And they do this because they're able to crush down their prices to the point where, the customer is paying the least amount possible. So it's not as if somebody threw a switch in 2021 and said, okay, now we're going to be evil monopolists and we're going to increase our costs or increase our prices so that we can capture more money from the consumer. It's just like, no, it's just, you guys created inflation. The price of everything is rising. We have to keep suits so we don't lose money. Because, if a company loses money, they can only do that so long before they go out of business, right? So it's either raise prices or go out of business. And the ones that are still around, a lot of businesses did go out of business. The ones that are still around, I have raised their prices to cover their costs. And that's just it. So yeah, it's a terrible idea. And, will they be able to get anything through? I think on this one, they'll actually have even more trouble because there's no real legal mechanism for them to impose like a nationwide anything when it comes to prices. But they could try through the power of tax and all this kind of stuff. There have been talks about windfall profits taxes and all this kind of stuff over the years. That's another one of those conversation shifters that never used to be a thing. And then somebody mentioned it 10 years ago and it's like, all right, oil companies are making a lot of money. Let's give them a special tax. And, they're just pushing the conversation so that they can establish these tools in the minds of everybody so that it can then sound later on like it's a reasonable thing to talk about.
And we've seen this before in the 70s with actual price controls in the fuel world like that. And it's for some reason it's breezed over. I think it's, because nobody even like gets upset about this. All they do is point when it comes to Nixon at Watergate and this massive scandal and what an evil man he was. And it's like, they point to that and that was everything wrong with Nixon. So forget the gold, untying the dollar to gold and forget the price controls that led to a lot of shortages for a lot of people in the 70s, which was probably way more economically harmful than anything that happened at Watergate.
Yeah, absolutely. But yeah, so we are, 50 years in now with the temporary closure of the gold window. So it's coming back. Don't worry. but yeah. So I was born in 1980, and so I did not experience the gas lines of the 70s. But I remember talking to my parents about it, and amongst the people who did live through that episode, there's a general feeling that it was the oil exporting companies like the Middle Eastern companies that were kind of holding America hostage. But if you look into the history of it, there were actually oil tankers off the coast of the U.S. just full of oil, just sitting there doing nothing. And part of that was because there were price controls in place and they could not actually afford to deliver the oil and obtain a profit. So it was actually cheaper to sit there and do nothing than to give Americans gasoline or sell Americans gasoline. So,
and they will still do that, which was evidenced, I think, was it 2021 when the price of oil actually went negative and there were tankers just sitting off the coast because they're like, we can't deliver this oil. We won't deliver this oil.
Right. Yeah. You have to have profits in order for any economic activity to happen. So it's like the fundamental insight of economics that is so underappreciated. And, Nelson Nash was great about like core economic principles where a voluntary exchange of anything involves two people coming out better off after the exchange happens, right? So I have money, you have a good. I want the good more than the money, you want the money more than the good, because we both have our, subjective valuations of things. So, we exchange those things and we both feel better. And that can only continue as long as that is true. So if you interrupt that dynamic, whether it's by law or by economic disaster or by, war or whatever, then everybody's going to be poorer off as a result. And that's just how it is. So, all these attempts at the government to fix their spending problem are never going to work, because you have to fix the spending problem. There is no amount of I have this book that I've had in my head for like 15 years, and it's the 16 things I learned about you by doing your taxes. Someday I'll actually write it. But one of the things is that, for people who are addicted, it could be to drugs, could be to alcohol, could be to gambling, could be to whatever. People who are addicts, there is no amount of money that they can earn to out-earn their addiction. I mean, and you look at famous cases like Michael Jackson, right? So Michael Jackson made billions of dollars over his career, and by the end of it, pretty much broke, right? There was the Neverland Ranch, and there was some stuff there, but when you factored in everything, not much left. And on a more personal level, I've seen this many, many times. People who get addicted to different things, no matter how much money comes in, they spend it all. And our federal government is the same way. It doesn't matter how much money comes in from taxes or from import tariffs or whatever. They are spending that plus more. So, the CBO, the Congressional Budget Office, they released a report a few months ago showing that the next 10-year projections of spending, and basically over the next 10 years, according to their report, which factors in no recessions, everything's perfect, just continuing straight line, that basically the deficit created each year, which is the amount of spending that Congress is going to do in excess of all the tax revenue and all the tariff revenue, is going to be, on average, about $2.5 trillion per year. And at no year in the next 10 years, less than 1.6 trillion. And, with current projections and current spending plans and all that kind of stuff. So all these things that have the public relations aspect of it is, we're going to raise revenue, we're going to make people pay their fair share of taxes, all this stuff. None of it actually fixes the problem. And the problem is there's too much spending. So until there is the political will to cut spending, which is really, really hard, because now you're cutting off somebody's, gravy train, then, we're just going to get deeper and deeper into an inflationary scenario. Because that's the only alternative, is we inflate, which is the hidden tax that nobody really pays attention to. I mean, there's been more focus on it lately because it's been so high. But, if you go ahead.
I was going to say, and actually, I'd like to tie that point all the way back to the beginning with the unrealized capital gains, because a lot of the capital gains people are experiencing, especially your everyday people in the stock market and these crazy runs we've had, is all directly related to the liquidity in the markets that comes directly from the Fed, that comes directly from fake money that's not tied to anything. So
Yes.
you're getting this inflationary silent tax, and then you're getting taxed on that with money you haven't earned.
Yes.
So it's a double whammy there with created dollars.
Yeah.
Anyway,
absolutely.
I don't want to jump back in there, but those are so closely tied together that you got to make that point that a lot of the gains aren't real gains. They're not gains in the value of that thing. They're gains that are due to the increase in the money supply.
Yeah, absolutely. So there have been a lot of people that have done some good work on demonstrating this. So one I've been talking with recently is Mark Moss. He has a hedge fund, and his whole thesis is that the global liquidity generated by the commercial banks and the central banks of the world are driving asset prices, which I think is 100% true. And he's got charts showing the correlations and everything, and effectively, it's something like 95% of the gains in the stock market over the long term are tied directly to the global liquidity flows. So that if liquidity is being created by the banks of the world, then market goes up. If liquidity is being drained by the markets of the world, which doesn't happen too often, but happens occasionally, then markets go down. So that is critical, and it's also I meant to make this point earlier. Capital gains is the only place in the tax world where we pay current dollars in tax on old money that is not inflation adjusted. So what that means is that I had a case with a client this year. So she bought a house in California, 2011, and then she sold it in 2023. And there was gain there, and it was a rental property, so she had some taxable gain there. And so whatever the tax was, she made, I don't know, when everything was said and done, she made a couple $100,000, and she paid whatever it was, 50 grand in capital gains tax, between state and federal. So okay, on the surface, that sounds fine. But I had a thought about this. I was like, well, we've had a lot of inflation since 2011. And so I went to the BLS, the Bureau of Labor Statistics. They have a calculator where you can put in, okay, $100 in this month in this year is equivalent to what in this other month in this year, and it'll default to current time. So if you put in the numbers in real terms, inflation adjusted, that $1 million in 2011 was actually had the same buying power in 2023 as like 1.7 million, or I forget the exact numbers, but basically the real inflation adjusted gain was effectively zero. But then she still had to pay 50 grand in tax on it. And it's the only place in the tax code where that happens. So, everything else is current year, right? So I earned in 2023, I pay taxes in the beginning of 2024, and okay, that's close enough that we can call it even, I guess. So, the the idea of assessing a unrealized capital gains tax is just going to make that even more extreme. So it's just going to make sure that you are paying nominal taxes on unrealized basis all along the way. So it just makes a bad problem even worse, effectively.
That is fascinating and infuriating.
Yeah.
What they've done with money and how they're robbing wealth through inflation from everybody.
It's a straight up cash grab.
Theft. Taxation's theft. We all know that.
I think it's more extortion than theft, but yeah, it's not good. So it's just you have to be really, really mindful of what is actually happening. And it's very difficult to look at this situation and make any other case other than you want to minimize your exposure to this as much as possible. And that's really the name of the game. I could definitely make an argument that nobody anywhere should be paying more than 20% in taxes. And, we can set up structures to do that. But yeah, most I was actually looking up the statistics this morning because the IRS does release good statistics. They're slow about it. But, the people who have a taxable income of under 100 grand, that makes up 2/3 of the pot of all the tax returns filed. So 67% are 100 grand or less. And when you go through all the adjustments and you end up with taxable income, and they pay 14% of the tax, and the rest is paid by everybody making more. So it's but everybody pays inflation tax, and that's actually the people who talk about making the income tax more progressive rather than regressive. What they're talking about is people who make more should pay more as a percentage, and that's how the income tax is set up. However, payroll taxes and inflation as a tax are both regressive in that they hit the lowest earners the most. So, whatever your talking points are, you have to be aware of what's actually happening and seeing how these effects are hitting the lowest earners the hardest. And and people feel this, right? You go to the grocery store. I went to the grocery store this morning. I paid $61 for that. Was just for me. I was just getting a couple things for myself, and that'll last me 2 days. I don't know, a day and a half. So yeah, I mean, it's just it's just crazy.
I'm impressed with your efficiency, man. You got a lot done this morning.
Neal, I want to ask kind of a philosophical thought on taxes. My initial exploration into the economic system, I was at Harvard Kennedy School for my master's program, and I had what you would call a economic celebrity cast of professors. So Janet Yellen was a guest lecturer in Larry Summers' class. My microeconomics professor was Jason Furman, who was one of Obama's chief economic advisors, somewhere in his cabinet. So if you're into economics, the names of all of those professors, when there's a Republican in the White House, they all come down to the Kennedy School and teach there. So I got to learn the opposite end of how I currently think. But at the time, I was kind of just in this, kind of the conservative malaise of like, well, I just don't, anything that the Democrats do, I don't like it. I just I wasn't thinking through it, at least in the economic side. But I would ask them questions as I started to kind of get more down this track of, towards eventually realizing, Preacher from Jekyll Island was what really opened my eyes. But what got me there was asking questions of these professors along the lines of, we're just creating money in order to pay the interest on the debt, which debt is the money we're creating. Like, and I specifically remember asking one of them, how long can this last? And the answer was that I don't see why it can't last forever as long as we can continue to pay the interest. And that's, the modern monetary theory, kind of the underpinnings of that. Stephanie Kelton at Kansas City, Missouri, or Missouri, Kansas City, whatever. So I kind of got down that track, and then I went into my final semester with this a much better, broader understanding. And I had spent the entire previous 2 semesters reading about macroeconomics. And I took a tax law class as a cross elective at Harvard Law. And I thought it was going to be I was hoping it was like philosophical thoughts on taxes, but it wasn't. It was more like, here's the tax code. And here's a situation that happened, and here's how the courts viewed it. So it was more like, let's analyze what his tax should be in this example for future tax lawyers. But I did ask a question along the lines of, is taxation theft? Why does it continue to, why wasn't the income tax removed immediately after its initial intended purpose, et cetera? The best answer, if I'm going to steel man the argument, the best answer the professor gave, or that most clicked a little bit with me, was, yes, we are taking from your production, but it is in order to contribute to the infrastructure that allowed that production in the first place. If you want to go out and be a farmer and homestead and raise your own food, and everything you have, you make yourself, and you make your own, all that stuff, right? You can go do that, and you can be pretty well free from the taxes. Not entirely today, but if we go back 100 years, if you just want to be a homesteader, you're not really dealing with the tax code. But if you want to interact in the business world, drive your car to a job that you didn't create, make money, it was like the idea that you are contributing to this body of work that exists and is, in that answer was, generated by the government. And so that, I don't really buy that, but if I'm going to steel man the argument, it's that I didn't create my car. I didn't create the job I go to. I didn't create the system that allows me to invest in the stock market. I earn money in the market, yes, but I didn't do a single thing to do that other than just put money in there. And so this infrastructure exists, and taxes are my contribution to that infrastructure. I just want to hear your take on that. Going, the comparison of like the farmer not paying any taxes because you're self-sufficient, to you are enjoying the benefits of societal development.
Yeah. So, I mean, it is an argument that is made. My response to it would be that, well, 95% of that has nothing to do with the feds. So if you're talking about, physical infrastructure, bridges and roads and all that kind of stuff, you can get into the argument as like, well, if these were privately owned, then you wouldn't have this tragedy of the commons kind of situation, all that stuff. But even taking the situation as it is, that's not a federal thing. That's a local thing.
Right.
And that's where your property taxes are going, and that's where your state and local income taxes are going. Now, under the current system, a lot of those state and local departments are funded in part by the feds. So there is some federal income tax going through that system and coming back around. So you could make that argument for that part. But that is a tiny, tiny fraction of what we're talking about when it comes to paying taxes. So if you wanted to go with that kind of minarchist sort of approach to taxation, then fine. Nobody should be paying more than a 10% tax rate, just across the board. But when you actually look at government spending, there's a couple big things. So one is interest on the debt, which you guys were talking about, which is basically just past screw ups that have been made. The second part is military spending, and the third and fourth parts of Social Security, Medicare. And those 4 categories account for the vast majority of government spending. And those things are generally not even discussed when it comes to all the things you see on the news about, oh, this budget proposal, that budget proposal, because those are considered, mandatory spending as opposed to discretionary spending. So the discretionary part is just like that last 15% of, the Department of Education, Department of Energy, Department of this, that, and the other. But the vast majority is just those 4 things: interest, military, Social Security, Medicare. And that's where your tax money is going effectively. Now, we know already that the taxes being paid don't cover that because we have a deficit every year. The government is creating, how technical do you want to be about the creation aspect? So the government prints bonds, which are then sold to commercial banks, which are then sold to the Federal Reserve, and the Federal Reserve creates money in order to give the commercial banks in order to give to the government. So the federal government itself is not creating the money, but that's the net effect. So yeah, I mean it's a naive argument, and if you were to follow it to its conclusion, you would also agree that the current levels of taxation are unsustainable and ridiculous. So, but the bottom line is that if you look historically, if you graph GDP versus tax revenues, it always fluctuates between about 15 and 20% of GDP as the max that the government can extract from the American taxpayer. And obviously you can get into the weeds of like, how is GDP calculated? Is that a real number? Should you add G as a factor, which is government spending, to GDP? But bottom line is that that ratio has been fairly consistent over time with all different kinds of tax regimes, and we ended up where we are today. 35. I can't even keep track of the number anymore because it grows so fast. I think we're around 35 trillion now. We're adding $1 trillion to the debt every 100 days or so, and your professor is right to a degree that as long as the interest can be paid, then the system can continue. The end result, though, is that you end up in an inflationary collapse. And how far are we along to that collapse point? Depends on historical circumstance, really. But people's appetite for using U.S. dollars as the purchasing power gets inflated away decreases. And as things become available as an alternative, so like the current big thing right now that is an alternative is crypto. So whether you're into Bitcoin or Monero or Ethereum or whatever, this is a place to put money that is outside of the fiat monetary system. So to the degree that people adopt that will hasten the point at which the interest can no longer be serviced. Because once you're printing money that creates interest in order to pay the interest, then you're in a doom spiral, and it's pretty much impossible to get out. So we're not there yet, because we do have enough. So tax revenue this past most recent reported year was about $2.3 trillion for the feds, and the interest we're now at a run rate of about $1 trillion a year. So there's still some buffer there, but once the interest portion grows to be greater than the tax revenue collected, then it's over, essentially. So how fast will we get there? I don't know. So the MMTers are interesting because they are partially right in that the government can just create money, and because we have a sovereign currency, the U.S. government operates on U.S. dollars, which it controls. So there is no technical default that is possible. That's all true. But they'll say in the parenthetical comments, it's like, oh, and there's the price to pay that is inflation. It's like, yeah, that's actually the problem, because eventually people don't want to use it anymore, and then the whole thing collapses. So
now, do you think this is totally just a speculation, but something I've always kind of felt, given the weird approach to crypto, and I'm not a crypto expert in the technicalities of any of it, but the way that it's kind of like, oh, no, don't do crypto. This kind of in a weird, like, they could just ban things. And I don't know how that, if they could ban Bitcoin, for instance, but it hasn't been targeted that aggressively. And I've just always thought, maybe could that be a form of, disguised quantitative tightening? Like, if you have this thing and you can get trillions of dollars absorbed into it, and then it can be crashed by just implementing a lawsuit like they did with XRP, or by just banning, you put people in jail for, I mean, I don't know what they could do, but this is total speculation here. There's no real answer to this, but
yep.
I've always kind of felt there's an outside chance that they could just try to, in the name of fighting inflation or quantitative tightening, just remove trillions of dollars that exist, all coming from people for the most part, just wipe them out by a crypto crash. Like, do you think there's any kind of, I suppose it's not really a question. It's more just a kind of a thought I've had, but like, it would be a way to implement quantitative tightening without blaming the Fed for the resulting deflation,
Yep.
which is what they need without actually changing policy. I don't know. It's like you can keep everything above the line the same and say, hey, we're not doing anything, and all of a sudden trillions of dollars evaporate. Whether that's through a stock market or through a crypto crash seems like a better scapegoat. But I've kind of wondered, because it's been a weird approach that they've taken to the market, where it's a threat, but we're not really that. How do we regulate it? It's been interesting, because when you think of like when a country wants to sell their oil in something other than dollars, for instance, we go in and drop some democracy on them, assassinate their leader, turn their country into chaos, and it's a signal for the rest of the region, like you were a thriving economy and now you are just a war zone, right? So we do that to someone who doesn't want to sell oil in dollars. We've done that a couple of times in our lifetimes. But something like crypto, which is arguably way more destructive potentially to the dollar, they haven't taken that same approach. It's kind of been a weird, I don't know. This is just, I don't know. I have a hard time seeing anything in the light that it's presented as. And so I've heard the arguments for it, and I understand that there is a, there is a role for it in the parallel economy, getting outside of fiat, et cetera. But I always kind of think, well, what if it, like, I don't think that's just random Japanese guy just created this thing that is the perfect antidote to the fiat system, and everyone's just kind of okay with it and lets it slowly develop. Those just, no need to even really respond, because it's not a question, but those are just a few thoughts I've had about that.
And he would be the first person that I know of in the history of the world that wants zero credit for changing the world completely. Like, that's weird to me. Like, I'm going to create this thing that disrupts everything, and then just, you're never going to find out who I am. I'm just going to scale back. That's weird.
Yeah, I think he's dead. I think that's what actually happened. But so crypto is interesting. I think when it comes to banning, the US missed their window. So there was a time from like 2013 to 2017 that they could have tried that, and some different countries have. But at this point, it's too successful, and it's actually moderately decentralized. And we're just talking about Bitcoin here. However, the introduction of the ETFs that got approved this past year do introduce that element of market manipulation that you're talking about. So once you have an ETF, and it's supposed to reflect the price of Bitcoin, but it quickly, because of the concentration of value in those ETFs, it becomes a driver of the price itself. So if you can manipulate a market to create a market crash through naked selling or whatever, then you can dramatically impact people's fiat value wealth if they have a lot in crypto. So it's definitely a risk factor. But yeah, whether they will do that or not, I mean, at this point in time, I think the market cap of all crypto is like under 2 trillion. So it's not enough of a thing to pull a lever on, but possibly in the future that could certainly happen.
I had a classmate who worked at the Boston Fed on the CBDC pilot project, and he was like, when you hear that they're going to start exploring CBDCs, they've wrapped it up. And this was 2019 maybe. And it was interesting, a couple years later, they're talking like, here's our white paper on how we're going to start exploring whether or not we could use a CBDC. And I was like, oh, interesting. That means they've got it. Yep. It's pretty much done. They've been researching it for a decade, and they're about ready to go. And that timeline that he mentioned of how long they've been looking at it at the Boston Fed, at least, coincides with how long Bitcoin has been around. So the part of me that doesn't trust anything I hear, like, that's an interesting tie-in. But I'm not smart on any of this. So like, if crypto listeners are out there just cringing right now, it's not like a thorough analysis. It's just thoughts that, at least on my end.
Yeah, the CBDC thing is very interesting in that if they were able to get it done and accepted by the marketplace, now you have programmable money. So if you're a new administration and you come in and not naming names or anything, you say, okay, 25% of every dollar is going to be taxed. Then if there's programmable money, then you can just program that. And you can say 25% of all transfers just get, siphoned off to the government, and nobody has any recourse whatsoever. So, it's a potentially terrifying tool that they could implement. So,
be analogous to a value-added tax.
Not as well. I mean, sort of. I'm just talking about like on every transaction, they could just take whatever percentage they want, and you could go to the Superman 3 route and make it just a tiny fraction, but it adds up because a single dollar has a certain velocity and turns over a certain number of times over the course of the year. Or you could go ham-handed with it and do something that people really get up in arms about.
I think I tried that in Office Space too, but he messes it up. Always mess up some mundane detail.
That's right.
Hey, I know that you have a hard stop at 1, and we've been chatting for a while. You might want to take care of some physiological needs. So I'm going to wrap this up and ask you 2 questions. The first one is, do you know of any asset that the government is not involved in, that they don't see the value of, that doesn't attach to FAFSA, that isn't taxed, et cetera, et cetera?
So, I mean, that isn't taxed. Yes. Things like IBC policies are not taxed because they are post-tax. So there is that, but they are involved. The insurance companies are regulated by the state regulators, and they're required to have, capital. What's the word I'm looking for? A certain base of capital compared to their actuarial obligations and all that kind of stuff. So they're involved, but it is untaxed or post-tax in most cases. So that is definitely an asset worth exploring for building long-term wealth.
Yep, and it's not reported.
And it's unrealized.
Yeah, so your unrealized gains are not reported, which is the key, which is what I was driving there for.
Yes, it is. They are unrealized gains. That is true.
And man, you have, we speak and somewhat regularly and on a group as well. But so I know that you have a lot going on, and you have some really cool things where people can do some self-service learning that you're unveiling. So what are the best ways if somebody was interested in what you're saying, not only that they can get in touch with you and maybe talk about having a relationship or, as a client, but even some of the other ways you're providing value for people who might not be clients? I know you're doing a lot of cool things.
Yeah, I have come to the realization that I can't talk to everybody. So, I've been building out tools and templates and courses that people can go through their own education at their own pace, but still implement some of these basic things to save them a whole bunch of money. So the best thing to do is to go to just taxsherpa.com. And in fact, what I'll do is I'll put up a page, taxsherpa.com/remnant, and I'll put together a little package for your listeners that they can get some understanding of how things like IBC impact, your tax situations, and how you could use that to start to build wealth and do it in a tax efficient kind of way.
Awesome. We'll make sure that's in the show notes.
Yeah.
Hans, anything to add?
Thanks for saving me tens of thousands of dollars in 2023, and looking forward to learning more strategies in the future. Like it's cool realizing it's frustrating knowing that these things have existed the whole time, and we're intentionally not taught them. And all of a sudden, for the first time, I realized, wait a second, I wasn't implementing any of these things. Now, part of that is being W-2 only, but now that we have a business, if you're listening and you have a business besides your W-2 income, there's so much you can do, and it's worth the investments. For me, I paid a high fee, like for this tax planning relative to any other tax thing I've done, or for most things I've done. Like for me, it was a large number, but it was returned 6 times in my tax savings, which is really, really cool because all of this stuff exists. Are you going to go dig in the tax code? I would highly recommend diving deeper into taxes with Tax Sherpa and finding out what's already out there. You just don't know about it.
Yeah. And the way I look at it, I mean, yes, we do charge money, but effectively it's more than free. So because you're always going to get more out than you put in. So it's,
Agreed. Yep. I had the same experience, and man, that was a good conversation. Had a lot of fun. I learned quite a bit. I appreciate the time.
Yeah.
Neal McSpadden.
Happy to be here, and keep on doing
Let's do it again.
All right. Sounds like a plan.
See you guys.
All right. Bye-bye.
Take care.